Welcome to Talk Tickers, where we break down the latest earnings calls for experienced investors. All right, today we're digging into NIQ's third quarter earnings, and frankly, this one's a bit of a head-scratcher. You've got a beat, you've got a raise, and then you've got a drop in the stock. So what on earth is going on here? Okay, just look at this disconnect. On one hand, you've got revenue beating estimates by a solid $18 million. They raised their guidance for Q4 and the full year. And the free cash flow, it absolutely exploded. So you think, great day for the stock, right? Well, not exactly. It popped over 7% at the open, but that rally completely fizzled out, and it ended up closing down almost 2%. And get this, on almost 3 times the normal trading volume. Something just doesn't add up. So before we try to solve this puzzle, let's break down the good news. I mean, we really have to understand just how strong these results were on paper. Let's dive into the bull case because it's pretty compelling. First off, the top line was humming along nicely. Revenue came in just over $1 billion. That's a 7.2% jump from last year. But here's the really impressive part. This is the 6th quarter in a row they've posted organic growth over 5%. That's not a fluke. That's consistent momentum. And if you thought the revenue was good, check out the profitability. Adjusted EBITDA margins expanded by 300 basis points. I mean, that's a full 3% jump, landing them at 21.3%. Management was really clear on the earnings call. This is all about operational efficiency, and a big chunk of that is coming from their new push into AI. Okay, but this right here, this is the real showstopper, the free cash flow. We're talking about levered free cash flow, the cash they have after all their debt payments, hitting almost $225 million. Now, to put that in perspective, last year it was just $56 million. That is a massive inflection. It really tells you that the post-IPO financial model is starting to work, and it's working in a big way. All right, but here's where things get a little murky and probably where some of that market confusion started. If you look at the official GAAP earnings, they posted a loss of 70 cents a share, a pretty big miss. But if you look at their adjusted non-GAAP number, they actually eked out a small profit of 3 cents, which was basically what analysts expected. That huge gap between the two is almost certainly due to one-off stuff like IPO costs, but it's messy, and messy numbers tend to make investors nervous. Okay, so we've got strong operations on one side and confusing EPS on the other. So what's the story management is trying to sell to Wall Street? Well, they were really hammering home one theme. This is just the start, and it's all being powered by AI. CEO Jim Peck was crystal clear on the call. He said AI is widening the NIQ data moat. And that's really the key here. They're not just tacking on AI as a buzzword. Their argument is that their huge proprietary data set, we're talking decades of consumer data, is like high-octane fuel for their AI models. It creates this competitive barrier, this moat that's almost impossible for anyone else to build. And they didn't just leave it at that. They actually laid out what they call their revenue algorithm, basically their recipe for growth. You start with a base of about 2.5% growth just from pricing power. Then you layer on top of that all the innovation from new AI tools. And finally, you get even more growth by upselling and cross-selling their big picture products to existing clients. It's a really clear 3-step plan. And, this isn't some far-off future plan. They pointed to a whole suite of AI tools that are already deployed and making a difference. You've got NIQ, their own AI engine, which is trained on a mind-boggling 160 petabytes of data. Their GenAI copilot, Ask Arthur, is already speeding up insights for clients by 40%. And they came right out and said that AI automation is a key reason those margins we talked about earlier expanded so much. Okay, so strong results, check. Compelling AI story, check. So why on earth did the stock end the day in the red? This is where we have to look at the market's reality check. Because despite everything management said, investors are clearly still skeptical. You really have to remember the context here. This company is brand new to the public markets. They IPO'd back in July at $21 a share. And since then, well, it's been a tough ride. The stock has basically been on a steady march downwards, and now it's sitting around $14. That's a 33% haircut in just a few months. Ouch. And it's not just that the stock is down, it's how much it's underperforming the rest of the market. I mean, look at this. Over the last 3 months, the broad market, like the VTI, is up 4%. NIQ, it's down almost 19%. That is a massive gap. The market isn't just ignoring the good news, it's actively punishing the stock. So what are the bears, the skeptics, pointing to? Well, a few things. First, those big, ugly GAAP losses we mentioned earlier, a net loss of almost $200 million this quarter. That's hard to ignore. Second, there's the debt. They're still carrying a multi-billion-dollar debt load from before the IPO. And finally, it's just become a show-me story. After a rocky start, Wall Street is basically saying, nice story, now prove it. Consistently.
Okay, so we've got the bull case with strong operations and AI, and we've got the bear case with GAAP losses, debt, and market skepticism. Time to put it all together and make a call. Here's our verdict on NIQ.
We're initiating our coverage on NIQ with an outperform rating. So why outperform? Here's the thesis. We think the market is getting this one wrong. It seems to be fixated on the ugly stock chart and the confusing GAAP numbers, but it's missing the real story, which is the massive inflection in free cash flow. That $224 million, that's real cash, not an accounting trick. It shows the business model is really starting to fire on all cylinders. Add in their credible path to higher margins and the fact that they just raised guidance, and the stock being down 33% from its IPO just looks like a major disconnect from reality. Now, for those looking for a specific trade idea, this isn't a recommendation, but one way to play this could be through long-dated call options. The thinking here is that if the company keeps delivering, the market will eventually have to wake up and re-rate the stock higher. Options could give you a way to capture that potential upside over the next 6 to 12 months as this cash flow story becomes the main story, not the exception. As always, this is not financial advice.